Welcome to Breaking News to Trading Moves.
Glad to be here.
Today we're looking at Meta's recent Q3 2025 earnings report. It definitely sent some mixed signals to the market.
That's putting it mildly. You had this real clash, great top-line numbers, but then these two cost items just dominated the narrative afterwards.
Exactly. So our aim today for you is to sort of break down those signals, the good revenue number, the cost issues, and see who might come out ahead and who might face some pressure.
Yeah, map out the potential winners and losers based on what Meta told us.
Okay, so let's start with the core numbers. Meta put up record Q3 revenue, right? Up 26% year over year. That's pretty strong.
Very strong. It shows the advertising engine is, well, it's working incredibly well. They know how to make money from their user base.
No doubt. But the stock dropped after hours. So let's get into the first reason why this huge one-time charge.
Right. The tax hit. It was a non-cash charge, $15.93 billion, U.S. tax related.
$15.9 billion. Wow. Okay, non-cash, you say.
Yeah, meaning it's an accounting charge related to past tax stuff, international operations, getting things squared away. It doesn't mean they wrote a check for that amount right now.
But it hits the reported profit number hard, doesn't it? Even if analysts try to look past it.
It absolutely does.
Yeah.
That headline number, seeing earnings per share drop because of it, that's enough to make some investors pause, even if it is a one-off.
Okay, so that's one piece of historical cleanup, basically. But the second flag is about the future, and this seems to be the one really driving moves in related stocks. The spending guidance.
This is key. They bumped up their capital expenditure forecast for 2025. Capex, that's the money they spend on like servers, data centers, all that core infrastructure.
Then the new number is?
They're guiding $70 to $72 billion for 2025.
70 to 72 billion. That's
Yeah.
a lot of money.
Yeah.
It puts them right up there with the biggest spenders globally.
It does. And they also signaled that CapEx in 2026 would be quite a bit higher still, mostly for the AI build-out.
Okay, but hang on. We've seen Meta spend big before, right? Reality Labs, the metaverse push, that didn't exactly thrill investors long term. Why is this AI spending viewed differently?
That's a fair question. I think the market sees this differently because, the metaverse spending felt more speculative, like building for a future that might be years away, if ever.
Right, uncertain payoff.
Yeah. This AI spending, the $72 billion plus, feels more foundational. It's about powering the core business now, improving ad targeting, recommendation engines, building their own large language models. It's almost defensive.
Defensive? How so?
Well, they need to keep pace with Google, with OpenAI, with others investing heavily in AI. It's about maintaining their competitive edge in the ad market, which is their bread and butter.
Yeah.
This spending is to secure their place for the next, 5-10 years.
Okay, so less about building a new world, more about reinforcing the current empire with AI.
I think that's a good way to put it. Building the engine that runs the existing platform, making it smarter, more efficient.
All right, so let's follow that money. If Meta's spending $72 billion next year, and likely more after that, that cash has to go somewhere. It flows to the suppliers.
Directly. And it signals sustained demand, not just a one-quarter thing.
So Category 1 winner seems obvious: AI chips and accelerated compute.
Absolutely. You can't do large-scale AI training and inference without specialized chips, GPUs, other accelerators.
And Meta needs tons of them, which points directly to companies like NVDA.
NVDA, definitely. They're still the leader there. But also AMD, who are making inroads with their own accelerators.
And it's not just the chips themselves, right? It's the whole system.
Exactly. It's the servers designed to handle these power-hungry, hot chips, which is why a company like SMCI, Supermicro benefits. They build these specialized AI server systems.
So NVDA, AMD, SMCI, got it. Is there a risk Meta just builds its own chips eventually?
They've said that's a long-term goal, developing more custom silicon, yeah. But the scale they need now, they have to rely heavily on external vendors for the foreseeable future. So it's still a positive for those guys right now.
Okay. Category 2. Where do all these servers physically go? Colocation and data center REITs.
Right. This hardware needs a specific kind of home. AI workloads need way more power per rack, generate more heat, need advanced cooling. It's different from standard cloud stuff.
So companies that provide that specialized space are set to benefit.
Correct. Either Meta builds more of its own massive data centers, which takes time, or they lease large amounts of capacity from colocation providers who already have power-dense facilities ready to go.
Which leads us to names like EQIX, Equinix, and DLR, Digital Realty. They own and operate that critical infrastructure.
Exactly. And building new data centers with that kind of power availability takes years. So the existing players like EQIX and DLR have a strong position.
Makes sense. Okay, third winner category, a bit more technical. High-speed networking and AI fabrics.
Yeah, think about it. You have maybe thousands of these super fast GPUs working on one problem. They need to talk to each other instantly.
Like zero lag time.
Pretty much. Traditional data center networks can become a bottleneck. So this AI spending includes upgrading the network switches, optics to handle massive data flows between all those processors at very high speeds.
So we're talking 400 gigabit, maybe 800 gigabit networking, creating these low-latency fabrics?
That's the tech, yes. It ensures the GPUs aren't sitting idle waiting for data. It drives demand for advanced networking gear.
Which benefits companies like ANET, Arista Networks.
ANET, yes, they specialize in this high-speed data center switching. And also the incumbent, CSGO, Cisco, they play in this space too with their own high-end gear and optics.
Okay, so NVDA, AMD, SMCI for compute, EQIX, DLR for space and power, ANET, CSGO for networking. That seems like a clear set of beneficiaries from this capex surge.
I think so. The spending commitment is large enough and sustained enough to provide a real tailwind for them.
All right, let's flip the coin. Meta's report wasn't all good news, hence the stock drop. What are the downside implications? Where's the pressure?
Well, the sheer scale of Meta's spending, plus that tax hit, it kind of changes the mood music for investors, There's a renewed focus on show me the money, on profitability, not just growth or stories.
Right. So category one loser, other social media platforms, the ad challengers.
Yeah. If Meta is pouring billions into AI to make its ad platform even better at targeting and proving return on investment,
then advertisers might shift their budgets towards Meta, away from smaller platforms.
that's the risk. If Meta's AI gets smarter faster, it becomes harder for others to compete for those ad dollars. It can strengthen Meta's walled garden.
So companies like SNP and PenSS could feel the squeeze. They're already competing against Meta's scale.
Exactly. They now face a competitor who's explicitly spending, $72 billion plus, largely to sharpen that competitive advertising edge. It makes their job harder.
Okay. Category two. This feels related to the investor mood shift you mentioned. Story over profits, AI equities.
Yeah. Meta's massive spending number is a sort of reality check. It highlights just how expensive it is to be a leader in AI development and deployment.
So if it costs Meta that much, investors start looking harder at other AI companies, especially those with high valuations but maybe not much profit yet.
Precisely. The narrative was all about AI potential. Now the questions are shifting towards the cost of that potential and the path to actual earnings. If you're burning cash and valued richly based on future hopes,
Investors might get impatient, especially seeing the costs involved at the top end.
that's the idea. So it could put pressure on names, perhaps like AI, C3.ai, or Path, UiPath, companies in promising AI areas, but where the market is now demanding clearer evidence of profitable growth sooner rather than later.
Right, the focus sharpens on the bottom line. Okay, finally, category three. Standalone VR plays.
This links back to Meta's other big spending area, Reality Labs. They're still reporting heavy losses there, right?
Yeah.
Billions per quarter.
Yeah, the metaverse investment continues to bleed cash.
And that serves as a sort of market signal. If the company arguably most invested in building the consumer metaverse, Meta itself, is still so far from making it profitable.
It suggests the whole VRR consumer market is still developing slowly, and it's very expensive.
Exactly. The adoption curve seems gradual. So that persistent loss-making at Reality Labs casts a bit of a shadow over other companies purely focused on VR or AR adoption happening quickly.
Like RBLX, Roblox, or maybe VUZI, companies whose fortunes are tied more directly to that immersive market taking off soon.
Yeah, it just underscores the ongoing costs and the still developing nature of that market's monetization.
Okay, so let's try and summarize the main takeaway for you listening. Meta's report confirms two key themes playing out.
I'd say so. First, that huge capex number, up to $72 billion for 2025 and rising, is a strong validation for the AI infrastructure providers.
So keep an eye on names like NVDA, AMD, maybe SMCI, ANET, EQIX, the ones building the AI foundation.
Definitely. The spending there looks robust. But second, the tax hit combined with that level of spending reinforces the market's demand for profitability now.
Which creates potential headwinds for companies maybe seen as less profitable or facing tougher competition, like SNP, PNS, or some of those high-valuation AI names like AI or Path.
Exactly. It's this tension, isn't it? The need for massive long-term investment in AI capacity versus the market's immediate desire for clear profit metrics. That's the dynamic to watch.
A really useful breakdown. Now, we just need to remind you, our listeners, that this discussion is not financial advice.
That's right. We aren't recommending you buy or sell any specific stocks.
This is purely the opinion of the author, based on the information discussed today. Always do your own research before making any investment decision.